All right, Rick. Well, this is now in person. So before I had you it was actually StreamYard, not Zoom, and had you on the podcast. But for one, I want to say thanks for actually coming into the office and being on this first in-person interview. To refresh the audience on who you are, what you do, and everything else, can you give us a kind of insight background to you and your credentials?
Yeah, I'm a little bit of an accidental tourist in the real estate mortgage space. I got here completely accidentally. Spent the first half of my career working for technology firms doing marketing. And after the dot-com bubble burst, I was consulting, and one of my consulting clients was this little startup called Realty. This was back around 1999. And Realty was publishing a database of foreclosure information, and in the process of changing from a regional player in California that targeted real estate agents to a national company that would provide this information to individual investors and consumers and real estate professionals. And before I knew it, I was on board there and happened to be there when the foreclosure crisis hit. And we were the only company with really a thorough national database of foreclosure information. And suddenly I found myself being quoted by more people in the media than just about anybody in real estate for a better part of a decade. So I was Realty for about 10 years, spent some time with a company called Carrington Mortgage Holdings, spent about 5 years with Auction.com, and about 2 years ago came back full circle. I'm now the EVP of Market Intelligence for ATTOM Data Solutions, which was Realty parent company. So ATTOM provides data on all 150 million properties in the United States to companies in real estate, mortgage, and insurance, to government agencies, educational institutions, and a lot of individual investors and real estate agents as well. So it's a good company to go to if you're looking for that kind of data.
Yeah, I mean, I think, I heard you first on Bigger Pockets, and I think, it doesn't matter if you're an agent or a lender or a flipper or, whatever it is, being more granular in the data is going to help you be even better at what you do and also more profitable. And I think that goes to say that's why these big companies do it. BlackRock, Blackstone, they have people in-house that do it for them. And then they take, your guys' data and then everybody else, and they combine it, and then they see where they should go next. Or like a builder, for instance, like D.R. Horton. So for you, I guess leading off with, all the bulk of what you just explained, we're in a flux now. We're in, a different market than we were the past couple of years. And I know if you've had, been in real estate or had your real estate license for the past couple of years, you could say, okay, well, I saw up, a bigger, higher, every month appreciation of homes. But now what do you see after 2022 comparatively the years prior? We don't have to go back fully, but what have you seen, in 2022 that was different and really data wise?
Well, the biggest difference in 2022 is what happened in the mortgage market. According to Freddie Mac, who tracks mortgage rates as well as anybody, we've never in history had mortgage rates double in a single year before. Yeah. And they actually doubled much more quickly than in a calendar year. It was in a matter of months because of what the Federal Reserve has been doing to try and get inflation under control. And that really hammered, I guess, affordability for a lot of prospective buyers. If you were looking at a house in 2022 and late 2022 that you would have maybe purchased a year earlier, the increase in mortgage rates would have made your monthly payment somewhere between 45 and 60% more expensive. Mm-hmm. And most of us didn't get a 45 or 60% raise year over year. So that was the big difference. And we saw a huge shift in buying patterns, which also shows up in the data. So this is the first year I remember ever where every month of the year we sold fewer existing homes than the month prior. And that happened January through November. I'm sure December numbers will be in the same direction. And so that threw all the seasonality we usually see out the window. Usually you see increased numbers of home sales in the spring and summer months. And this time that didn't happen. So affordability became an issue. It led to fewer home sales. We saw a lot of volatility in the new home market. And we're in probably for more of the same. You and I were talking before we got started today about some industry trends. over 70% of existing mortgages today have an interest rate of less than 4%. Those borrowers, those homeowners aren't going anywhere.
No.
If you don't have to sell a home today, you're not going to trade a 2.5% mortgage for a 7% mortgage on a more expensive property. And oh, by the way, sell your home into a market where prices may be declining. So that's going to keep the inventory levels really low again as we go through 2023, which is bad if you're looking to buy a house. On the other hand, I guess if there's a silver lining in that cloud, the lack of inventory is going to prevent home prices from cratering. So we won't have another huge price decline like we did back during the Great Recession.
Yeah, there's an agent on the East Coast that talks about like the Cold War of, basically holding your house and not doing anything with it, not refining, maybe it's sometimes depending on what the equity structure is, doing a HELOC, but not really doing anything. You don't need to trade up, trade down. Granted, there's going to be those, mandatory homes, but I think that's where you don't see this significant, hey, I'm just going to list my house. It's so low now where, they have a mortgage of $2,500, and if they try to refi now, it's going to be $3,800, and they can't afford that. And it makes sense, because why are you going to move unless maybe you had, triplets, or, you had to do something where, or you're moving out of state because of a job relocation, or you want to get out or something like that. But I think overall is the sentiment is you're going to stay put, right?
Yeah, if you don't have to sell, you're not going to sell, is the short answer. It just doesn't make any sense. One of the things that really drove price declines last time, go back to 2008, 2010, is forced selling. So we had 15 million adjustable rate mortgages all come due. They all reset from low teaser rates of 1 or 2% mortgage interest to market rates, which back then, by the way, were 6 and 7%.
Yeah.
So your mortgage rate was tripling.
Yeah.
And these homeowners simply couldn't afford the new payments. So they had to sell, and they sold into a declining market that was oversaturated with properties. We had a lot of foreclosure activity, which drove prices even further down, and it became a race to the bottom. And none of those characteristics are in play right now. So very, very different market conditions. I think the Cold War analogy is a good one. Economists refer to this as rate lock. So you're kind of locked into your home with a 2.5%, 3% loan. You're not going to move out if you don't have to. We are seeing some migration, though. You touched on this, people moving for jobs. There's a lot of people that can now work from home.
Yeah.
And you're seeing people sell homes in high price, high tax states and move into states with a lower cost of living. And so you are going to see some of those properties come on the market, and the sellers are willing to take less than top dollar on the market because they're still going to make a lot of money. They still have a ton of equity, and it's going to be much more affordable where they move. But right now, if you took that $2,500 mortgage you were talking about here in Southern California, sold your house and rented a place, you'd be paying more than that just for the rental.
Yeah.
So you're just going to have an awful lot of people staying put for the foreseeable future.
Yeah, I mean, I've been an advocate now for, my clients is, okay, well, since it's changed, since the market's changed, maybe they've been on the fence for quite some time, 2.5 years. Now you can get a price adjustment. Okay, so you go in, I'm working with you, you go in and you're looking for maybe a $600,000 house. Well, now we can get it for, $570 and maybe $5K back at closing, or $10K back, take $5 and buy down the rate, and then $5 and use it towards closing costs. So you're out of pocket less. Obviously, your mortgage is going to be a little less because you dropped at $30K, and the rate buy down is going to give you a little better, cushion as well. So I've had a lot more buyers that were, looking for a long time that were maybe FHA or lower down, but now they've really, went in all, full tilt to be able to get a home, because now it's more affordable for them because they can do those things, and you can kind of be a little bit more, aggressive on that front, which is nice for buyers.
You need to be more creative than you were a year ago or 2 years ago. And you need to do that because it's tough for people to adjust from looking at a $500,000 house to a $250,000 house. But if you can get that house that was $500 last year for $450, and do the kind of creative financing you were talking about, by paying to buy down the rates and things like that. The other thing that if you can afford to buy the house right now, the likelihood is that interest rates are going to go down in the next 18 to 24 months.
Yeah.
So you also have the opportunity to be able to refinance at that point and maybe reduce your monthly payments,
Yeah.
which is certainly something you can't do if you're going to be renting a place. You were talking about, but to your point, Peter, really important for people to be working with professionals that can guide them through this, whether it's a real estate agent, whether it's a mortgage broker, somebody who knows the ins and outs of these kind of moves. Something you didn't mention, but you mentioned FHA borrowers. Virtually 100% of FHA loans, mortgages, are assumable. There's a way to buy a house from an FHA borrower where you assume their mortgage with the old interest rate. Now, you usually need to take out a second loan to make up the difference in the equity that you're going to pay that homeowner. But at least for the bulk of your mortgage, you're still going to be looking at one of those much lower mortgage rates than are available on the market today. So there are workarounds to your point about finding ways to make these homes more affordable. It just takes a little bit more research, a little bit more work.
Yeah, for sure. And I think that, in these markets, you got to put in the work. You're not able to just, get your license and then go out and do this. Doesn't matter if it's on, or not get your license, but go flip, a bunch of homes. I've had a lot, and I've read multiple articles where a lot of investors that were flipping have taken all their chips off the table because they don't know exactly what's going on. And I've had clients that, we're flipping 15 to 20 homes that are now like, hey, I'm going to hang it up for a while. I'm not going to, look at any properties, pencils down. I'm not going to do anything.
There's probably some flippers who do this for a living that we both know, who have mentioned lately that they're writing checks to close deals.
Yes.
And if you're a first-time flipper, or if you're just starting out in that part of the business, you probably don't have the cash reserves to be able to do that. So it's a tough market. A perfect flipping market is where you have high demand, low supply, and rapidly rising prices.
Yeah.
We don't have rapidly rising prices. Demand is a little bit weaker than it was because affordability is an issue. Demand is probably still stronger than supply, but it's just not a perfect market for flippers. We just issued at ATTOM our Q3 flipping report, and it was one of those classic good news, bad news reports from a market perspective.
Yeah.
It was the second highest total number of flips we've ever recorded in a quarter. We've been recording flips since 2000, so big number.
Yeah.
But both the gross profits and the profit margin, which is gross profit divided by what you paid for the house, dropped as quickly as we've ever seen them drop. So the margins are compressed dramatically. And keep in mind, I'm talking about gross margins. So that's not factoring in increased materials cost, increased financing cost, increased labor cost.
Yep.
So if you're going to be a flipper in today's market, you really need to do your homework. You have to be really good at math. I wouldn't put the pencil down. I'd sharpen the pencil and make sure that you're not overestimating what you're going to be able to sell the property for, and you're not underestimating the cost of the repairs.
Yeah.
Because you make those two mistakes, and suddenly you look like Zillow and Opendoor did. Zillow lost $372 million in a quarter on their flips. Everybody thought that was just insane until Opendoor announced they'd lost $1 billion last year. And it just shows you if you make little mistakes on a property and do it at scale, it turns out to be a pretty big number. And that's the challenge for flippers these days. There are still opportunities, but you really need to know what you're doing.
Well, I even say, if you look at those big companies where, you got and I've talked about this before on the podcast, but you take those big companies and they're not hyper local. They're all across, the United States. So they got caught because you and I know Orange County. If we went into certain, cities and stuff like that, oh yeah, I know that. Do I know each street? No. Do you know? But we know Orange County. So if you and I teamed up and we went out and did flips, we would feel comfortable doing Orange County. But then if someone said, hey, Rick, Peter, do you guys want to go do San Francisco? We'd have no idea,
right.
Unless you lived there for 20 years. So that's where I think that they got in trouble, and obviously the market. But if you look some of the tax rules on these properties that, Opendoor, a lot of them are Opendoor because I don't even see Zillow. Zillow stopped. But Opendoor, where they bought it for more than what they have it listed for now. And it's been listed for 120 days. Yeah. Then you get, concessions talking about, being a little bit more creative. There's concessions on top of that. So yeah, they've lost, like you said, $1 billion because for one, the market changed, and two, they were in a scenario where they were very, very, spread out and spread too thin because they thought they could use this business model and spread it out across the nation, right?
It was always going to be, the iBuying model was always going to be a challenging model. And one of the things your audience needs to keep in mind, for those that are flippers, is these really weren't flippers. These were arbitrage folks. They were trying to buy slightly lower than market value and sell slightly higher than market value. So it was all about pricing for them. And if they got the pricing wrong, it was going to have major repercussions. A flipper tends to add a lot of value with the repair work.
Yeah.
And so that's where a lot of your margins are delivered as a flipper. So slightly different business models. But my suspicion was, and I think this is actually happening now, but when I saw the iBuyers come into play, my suspicion was that they ultimately wouldn't control the bulk of the market. But what we would see is local and regional players come up. And I spoke with no fewer than 5 companies at a recent conference, an investing conference, that are regional or local market iBuyers. So they're not flippers in the sense they're buying an individual house, fixing it up, and selling it.
Yeah.
They are doing the iBuying. We'll pay you cash today, and you can move out and move on, and we'll resell your property. But they're people that do know their local markets, to your point, and I think that's a huge, huge difference.
Yeah. I mean, kind of the wholesaler model and, those types of models are going to be the ones that are, for one, as long as you sharpen the pencil and you know what your AVR is, so your out price, and what you can buy the property for, they're still working it and they're still being able to get, properties sold. Some big wholesalers that are local are still selling properties. I still see them. I'm still on their email list where they're saying, hey, we sold this one. So there's still people buying out there, but it's just, you really got to be, headstrong on what numbers you're going to go in at, what numbers are your rehab costs, and what your margins are, and really make sure that the AVR is going to pencil out, because you don't want to be stuck where you're trying to sell something or write a check, right?
Yeah, you don't want to be writing checks. And also a lot of people have shifted gears to where they're not looking at flipping anymore. Some flippers have become wholesalers.
Yeah.
And typically their end buyers are rental property owners. So we are seeing even some flippers who have decided to, at least temporarily, become landlords. And there is a continuing demand for rental properties. The single family rental market has grown from about 9 million properties back in 2009 to about 19 million last year.
Really?
So it's more than doubled in a little more than a decade. The big institutions get a lot of the press, but the reality is they still only own about 2.5% to 3% of that inventory. It's mostly mom and pop investors, and they have found more properties to buy, fix up, and rent out to local market tenants.
Do you feel that, because I know there's a lot of, big investors that are out there, Blackstone, BlackRock, that are buying, do you feel later down the road that they'll continue to buy from mom and pop shops and there'll be a bigger, stranglehold on the market? Instead of 2%, maybe they're, 15%? Do you see something like that happening?
No, I don't see them getting that big. And Lord knows they have the money if they wanted to do that.
Yeah.
But, for whatever reason, they're the ones that started the growth in this market back in 2009. It took them over a decade to get from 0% to 2%, 2.5%. So I don't think I think there's probably not enough capital in the institutions combined to buy that much inventory. And I also think there's a lot of capital in local markets that's being spent by local mom and pop investors who don't have the same rigid buying requirements that the institutions do. That's the other thing you have to keep in mind. They sort of self-select what they'll buy. And so if it's not a 2-bedroom, 1-bath, 1,500 square foot home without a swimming pool that's been built since 1985 and has a lot size of X thousand square feet, it doesn't fit their buy box and they don't buy it. So that leaves a lot of inventory for other people.
Yeah.
They buy these properties in large part to create public REITs. That comes with certain restrictions. So I don't think they ever become this overarching rental property I don't know, magnate that everybody's expected. If they were going to be, I think they'd already be there.
Okay.
The other thing that we've seen the institutions do that's a little different than what we've been talking about is they've shifted a fairly significant amount of their capital into build to rent
Yeah.
assets. And so they're, instead of competing with individual investors or individual home buyers for a specific property, they're going to D.R. Horton or some other builder and saying, hey, let's build a neighborhood of rental properties. And so that to me is a much smarter approach for the institutions, gives them much more transparency into what their pricing is going to be, gives them more control over the quality of the assets they're building, maintenance costs, the actual geography of the properties being more proximate.
Yeah.
So I'm kind of surprised they didn't get into that earlier.
Yeah.
But I think that's where I've seen more of a shift than the big institutions coming out deciding to spend more money on single family property purchases.
Yeah. No, I've seen that, heard that, read a lot of articles on that. And let's talk about builders. What have you seen? Because I've personally seen builders, slash prices now, give a lot of concessions. Doesn't matter if they're going, if that buyer's going with their lender or, their own lender. Because usually builders, if they go, in-house lender with the builder, they'll give, $10,000 back, 2% of the sales price back, stuff like that. So what have you seen on a builder front for your guys' data, what it's been doing across? Because Southern California, there's been a lot of price reductions, Lennar, D.R. Horton, what have you seen across the nation?
The new home market's always going to be a little bit more volatile than the existing home market in a changing rate environment.
Okay.
And that's, I think, what we're seeing. So if we talked about this earlier, if you're an existing homeowner with a 3% mortgage and you don't have to sell, you're going to stay put till market conditions improve. Mm-hmm. If you're Toll Brothers or Pulte or D.R. Horton or somebody else, and you have a half a dozen properties in a development that are sitting vacant, they're costing you money every month.
Yeah.
So if you have to offer concessions to get them off your books, if you have to drop the price a little bit to get them off your books, if you have to buy down rates to get them off your books, you'll probably do that to get them off your books, recapitalize, and move on to your next project. So we are seeing a little bit more of that kind of fluctuation in terms in the new home market. The other thing we're seeing, and this probably won't be a surprise either, is a double-digit drop in housing starts. So the builders did get the memo this time. One of the problems with the Great Recession is they missed their window. People stopped buying homes and the builders kept building. Yeah. And suddenly we had a 13-month supply of homes available, which is twice as much as the market can absorb.
Yep.
And so that also contributed to pricing declines. This time when buyers slowed down, starting in July, we saw an 18.5% decrease in housing starts year over year.
Really?
And the builders have not come back in a meaningful way ever since. So both builder sentiment is actually almost as low as it was during the worst part of the pandemic, and housing starts have followed suit. They've come down significantly. Simultaneously, we've seen an increase in multifamily starts.
Okay.
So we've also seen some surveys that suggest that as many as 20 to 30% of people who are thinking about buying a house have decided they're going to rent for the next year or two while they're, again, waiting for market conditions to settle down.
Okay.
That suggests there might be an opportunity for more rental units. So the builders, I think, have shifted gears. The ones that build both have shifted gears, but in other cases, it's just a bit of a ramp up in multifamily starts and a drop in single family starts, which, by the way, will also keep inventory low.
Yeah.
And to a certain extent prevent that kind of oversaturation that leads to price declines.
Because it's multifamily. Yeah, for sure. Yeah. So do you guys pull the permits pulled? Is that how you know for starts on?
We do get permits, but we also follow Census Bureau and NAHB reports on housing starts because they do that as well as anybody does.
Yeah.
The other thing I think you'll see, this is me speculating, but the other thing I think you'll see next year is a bit of a softening in new home prices. And before people get too excited, that doesn't mean you're going to get a $600,000 home for $450,000.
Yeah.
It means the builders will build a $450,000 home because they are sensitized to the affordability issue we talked about earlier,
Yeah.
and realize that the people who might have bought that $600,000 house can't afford it right now. So, but they're not going to build you a $600,000 house and discount it by 150 grand. They're going to build you a less expensive property.
Yeah, what do you think about like the big drops in Phoenix that we've seen, and also Boise? Boise's another one that we've seen, bigger drops. What type of, have you guys looked, or have you specifically looked at that data, and what's your feedback on that?
There are a handful of markets. So actually, let's take that up a level and talk about a broader issue. We're thinking that home prices nationally probably decline about 5% this year.
Okay.
That's a little more aggressive than what Fannie Mae's predicting. They're looking at about 1.5%. National Association of Realtors, I believe, is required by law never to say anything negative, is calling for prices to be flat this year. I'm just kidding. They have a great economics team. But we think there are markets like coastal California, like the Pacific Northwest, individual markets maybe like Phoenix, Las Vegas, Boise, Austin, where prices accelerated so dramatically that they almost have to claw back a little bit more aggressively. But there are also going to be markets in the country, and I'm thinking of the southeastern states in particular, the Carolinas, Tennessee, Florida, where you're likely to see home prices continue to go up. So this will not be a universal decline like we saw back in 2010. This is going to be very much a local market correction. You mentioned Boise, you mentioned Phoenix. Phoenix is a market that was heavily impacted by investor activity last year, or in 2021. And as the investors are kind of withdrawing from the market, that reduces demand pretty significantly and can lead to price declines. Boise was a market that was just a unicorn. In 2021, home prices went up by 47% in Boise.
Yeah.
It was people from San Jose selling their home, pocketing 900 grand, going to Boise, paying 500,000 for a house that was listed for 250, and not caring. And it just that's an extreme scenario, but that was basically what was happening. It was out of town buyers coming from more expensive regions, paying cash for properties. So it's not like those properties are going to foreclose because there's no mortgage. But there was nothing organically going on in Boise or St. George, Utah, or Phoenix that was making prices go up 40% a year. And as market conditions have returned back to more normal, you're going to see a little bit of price clawback. But I'll give Lawrence Yun, who's the chief economist at NAR, credit for this. We were talking about the prospect of a recession, home prices declining, and he said, look, if you're in Phoenix and home prices have gone up 50% in the last 2 years, if you have to go back 10%, is that really a catastrophe?
Well, real quick, that's what I've always, well, not always, the past 2 years, what I continue to say is, okay, well, let's say we went up 25% here across the board, and you could probably correct me on exactly what Southern California has gone up, but 25-ish, 20 to 25-ish percent. Well, if you go back 4 or 5%, what you guys are predicting, you're going back to 20% or 15%. You're not going, if you said, hey, we're going to fall 30%, and I know you're not saying that, but if you said that, okay, well, then now we have to make back the ground that we lost and then get back to where we were initially. So that is a big drastic change. You're not saying that. And here's the thing is, we're not at least seeing that, especially because the inventory, where we're at on inventory is not what it was back in, we don't have this plethora of houses that are listed, that are vacant, that you could drive by a street and have 15 for sale signs, up in the front yard. No,
and that was we've all seen that movie. It didn't have a good ending. I'd rather not see the sequel. No, you just characterized it exactly right. And there will be markets with price declines. And look, home prices don't always go up. However, if you look at the last 100 years of home prices in the United States, we had one period of time where prices dropped 20% and didn't recover immediately, and that was the Great Recession. So I think a lot of people still have PTSD from that Great Recession. They believe since prices skyrocketed then and crashed, the likelihood is since they skyrocketed this time, they'll crash again. And again, none of the other market conditions are in place. So it's not out of the question that the Bay Area in California might see a 10 to 15% price decline, especially at the upper end of the price range. I do think entry-level properties across the country are still largely price protected because there's still not enough of them to meet demand. And so you'll still have people bidding on those properties and keeping those prices from falling too much. You have a market like Phoenix, you have a market like Las Vegas, you have a market like Austin where prices were just skyrocketing beyond rational numbers.
Yeah.
They'll probably pull back a little bit. But again, if you're in Raleigh, North Carolina, if you're in Jacksonville, Florida, if you're in Nashville, Tennessee, wouldn't surprise me at all if your property values went up 4 or 5% this year. So it's for investors playing in this market, really, really important to understand the local market that you're buying in, whether it's your hometown or not.
Yeah.
The market conditions are going to be all over the place. So what I tell investors to look for are markets where you see population growing and you see jobs growing.
Okay.
Because those are two factors that tend to prompt a very healthy housing market, whether you're a rental property owner or you're a flipper or a homeowner yourself.
Yeah.
So I do worry a little bit about states like California and New York, and Illinois, which all lost in excess of 100,000 people in terms of net in-migration and out-migration last year. You can do that for a while, but at some point, if the numbers keep going in that direction, it does start to have an impact.
Yeah, I was going to ask you about that because you were talking about people exiting or moving different locations. So for California, since we're here, what type of have you seen a change because people have moved out the past, I would say 2 years now, 3 years? Have you seen a change in any type of data that's come across your desk because of the move? Or when do we get to a point where it's like we've done $100,000 or 100,000 negative in population each and every year for the last 10 years? Now it's going to hit us.
So part of it depends on the population leaving. A lot of it right now is retirees who simply can't afford to stay in California on their retirement income. We had such a severe housing shortage in California that I hate to sound cavalier, but losing 100,000 people probably didn't make an impact at all.
Okay.
We're probably multiple times that short in terms of homes available for sale. That said, some of the higher priced markets are where we're seeing price declines already. San Jose is one of them. San Francisco, the Bay Area, is another. We're not seeing it yet in Orange County. If you're looking at month-over-month numbers, they've been going down since the fall, pretty much across the state. If you look at year-over-year numbers, at the end of November, Orange County was still up a little under 1% in terms of prices year over year. So it'll be interesting to see how that all plays out in 2023. I suspect we will see prices dip a bit statewide. The California Association of Realtors is projecting a 10% decline in California home prices.
Okay.
But even then, I believe you'll see that vary wildly by region of the state and by the price tier the properties are in.
Okay. And then if you look, what I feel and what I've seen on articles and everything else is a lot of people that are moving into, or if they're not moving out of California, they're moving from like San Francisco down to Orange County or San Diego, or LA down to Orange County or San Diego. Have you seen that? Have you seen the data on that?
I'll tell you what we have seen, because I think you're right there. We've seen a lot of people move into the center part of the state.
Okay.
So, and we saw a little bit of that during the run up to the Great Recession. We saw Riverside and San Bernardino counties exploded.
Okay.
The Inland Empire here in Southern California, and then Central Valley was growing at a similar rate. And during that cycle, those were bedroom communities. So somebody would buy a home in Riverside because that's what they could afford, but they'd commute to Orange County, they'd commute to LA, they'd commute to San Diego. Awful commutes, but that's what they would drive until they could afford a property.
Yeah.
And when the market shifted, that all fell apart.
Yeah.
And that was tied into high job loss too, by the way, back then. This time it's different. We're seeing people go buy houses in Riverside and San Bernardino because that's where the jobs are.
Yeah.
So Amazon's opening warehouse and distribution centers. We're seeing cloud computing centers open up in those regions because there are more people working from home. You need more distributed computing power. We're seeing cannabis facilities growing up in so to speak, in those kind of central of the state areas because real estate for those kind of facilities is cheaper. So people are no longer moving there and commuting to Orange County. Mm-hmm. They're commuting a few miles to the warehouse and distribution center working for Amazon. And then other people are moving there and starting businesses to support the new workforce.
Yep.
And so they're living there now. So I think that's a fundamental change in migratory patterns within the state of California that we're seeing compared to the last cycle. And I do think you're seeing a lot of people from Bay Area parts of California move to other parts of the state, and whether that's San Diego, and I've heard a lot of that anecdotally, or Sacramento, which I've heard a lot of anecdotally. I do think that's a trend that you're seeing. And San Francisco's in danger of the downtown area becoming a ghost town. The vacancy rates for the offices in that market are approaching 50%. You're seeing companies like Salesforce to send all their folks home to work. Mm-hmm. And that affects a lot of the small local businesses that were there to support the workforces. Yeah. And it's a nightmare. So of all of the major metro areas in the country recovering from COVID, San Francisco's had the toughest time of all of them.
Oh, yeah. And I mean, you see all these, like you said, big companies, Twitter, Facebook trying to minimize their, footprint on square footage that they're going to be renting and or owning. And a lot of these big companies, tech companies specifically, have backed out of contracts, right when they were going to sign on the dotted line, or they already signed and just said, hey, we're not going to, commit all our money to something where we don't feel, comfortable anymore. And you've had CVS, 15 or 17 or 25 locations, in the Bay Area just leave because of, different changes in politics and stuff like that I think is going to dictate a lot of the moves.
You can say it's crime.
Yeah, like a lot of the crime. Like the crime and the ability to tamper that crime has been, let loose because the laws have changed. And it's sad to see because San Francisco used to be, a very sought after city for one to live in, for two for companies to go to, and three for people, to just go visit. So now it's changed.
Oh, it's sad. San Francisco, at its best, is a beautiful city. It's a cosmopolitan city. It's about as close to an international city as we get in the United States.
Oh yeah.
But the politics have ruined the city, and it will take a lot of effort for the city to pull out of this downspin. It really is a shame, and it will have an effect on the budget of the state because it's again we live in a state where a lot of the state's fiscal resources come from its major metropolitan areas.
Yeah.
And if those areas are facing hard times, that's going to have an impact on the overall state budget. So, nobody's rooting for San Francisco to fail, but it's a shame to see what's happening in the city.
Yeah. I mean, I feel that, San Francisco and, LA are two pinnacle, areas that need to stay in place to really, solidify California as a state, like you said, basically financially. And if you continue to, have policies that are going to change that, it's going to, have a drastic impact on just the ultimate income of that city. So that's a lot of things that people have, seen and then either moved out of state or moved, to different areas that still, put the money into those buildings, put the money into the area to be able to, make sure that it's safe for people to go to work and or, the store. Mm-hmm. So, that's a huge thing. And then I want to go back to what you were talking about for Phoenix. So was it investors? Because you said that there was a huge uptick in investors. Was it for multifamily or single family?
A lot of it was single family. There was probably both, but
Okay.
A lot of it was single family investment. And whether it was the iBuyers who targeted Phoenix early, whether it was fix and flip investors or single family rental property investors, Phoenix was one of the cities with the highest rate of investment activity. Atlanta was probably highest in the country. We haven't seen the kind of fall off there yet, so maybe market conditions are a little different there. But it'll be interesting to see how some of these markets, and the three that we're watching most closely are Atlanta, Phoenix, and Las Vegas, how they fare through the cycles that we're going to go through in 2023.
Yeah, I mean, I know you could probably speak to this more than I can, but, '08, 9, 10, 11, Phoenix lost a huge amount of market share with, just prices and everything else. And the same thing as, Nevada, into Las Vegas, huge drastic drops in prices and everything else. Have you seen, because I know, like, if it's a vacation spot or, it's a transient spot in the sense that people go there to have fun on a weekend and then come back home, have you seen a lot of price decreases and or, changes in the market in Vegas just because of that over the past? And do you see it going forward because of the possible recession?
Haven't seen it yet. Wouldn't rule against it. Heck, it would take one more bad variant of COVID to throw Las Vegas sideways again economically. That if people are afraid to travel, if they're afraid to congregate, that hurts your destination areas. We haven't seen the kind of fall off in any of those markets yet that we did last time, and partly that's because a lot of the buying activity last time was by speculators, and they were buying at prices that didn't make any sense, with the thought that prices would go up forever. And when there was a pricing downturn, when their adjustable rate mortgages reset, it just built on itself, and it was a calamity from a pricing perspective. We're not looking at that kind of situation yet. Phoenix prices are down double digits year over year. I think there's a bottom to that. That's kind of a natural bottom, because it had gotten to a point where it was almost unaffordable for people to buy a home in Phoenix.
Yeah.
Combination of those prices coming down, some of the creative financing you talked about, we'll get to a point where affordability looks better for people looking to buy in Phoenix and in Scottsdale and in Tucson. And I think there's still pent-up demand for those kind of properties.
Yeah. No, I see that too. I think that, it could change, and drop off, and depending on, what happens with CPI tomorrow and what they're going to report, and then, what the feds do and everything else. But it's interesting to me what Phoenix did, last time in the downturn, and Nevada to go forward, if that's going to happen or it's still going to stay strong. That's always been my concern.
Big part of the Phoenix issue last time was foreclosures.
Yeah.
And a lot of those speculative buyers just mailed the keys into the banks. So now you had literally thousands and thousands of vacant, abandoned properties that the banks candidly couldn't afford to sell. Little known fact in accounting circles is that if you own one of those properties, you don't have to book the loss until you actually sell it. So while it's on your books, it has an imputed value. When you sell it, that value has to change to what you actually sold the property for. And there were just untold billions of dollars of losses that these foreclosure properties represented across the country. So that's one of the reasons it took so long for these things to ultimately come to market and get sold. Because if you were a lender, operating on thin margins in those days, flooding the market with properties you were going to lose money on just really wasn't a particularly smart strategy.
Yeah, no. Wasn't a smart strategy at all. What do you think about this? You talk about adjustable rate mortgages, the ones that are coming out now, or, have always been in play, but people never really dabbled in them, the past 10-ish years because the interest rates have been really good. The 5-1, the 7-1, the 10-1 ARM. How do you feel about those? Do you have any, context or data on, people going into those types of mortgages? Where it's farther out, it's 5 years out, or 7 years out. What do you feel about that, or what have you seen on that?
So a couple things. One, the scale is nowhere near where it was when things went horribly wrong. So entering into that downturn, we had 15 million adjustable rate mortgages all coming due to reset. Most of them probably never should have been made because the borrowers weren't qualified.
Yep.
And a lot of them were made with teaser rates. So they were 1-2% interest. And when they reset to market rates, it just became an unaffordable cost for the borrowers. This time, when rates started to jump up, we had about 1.5 million adjustable rate loans. So a tenth.
Yes.
These were much more carefully underwritten loans. They had much stricter loan guidelines. And one of the guidelines that is in almost all of these loans is a cap on how much your interest rates can go up in a given year. So in most cases, for example, a loan, once it hits its reset period, will go up at a maximum of 2 points a year.
Okay.
So you're not going to go from 1% to 7%. You're going to go from 2.5% to 4.5%. So your monthly payment will go up,
Yeah.
but it's not going to triple.
Yeah.
And that's the ones that were already in place. To your question about the ones being made today, again, much more stringent underwriting standards. These are much better qualified buyers. They're required under the CFPB's rules to be able to afford that adjustable rate loan under today's fully indexed prices, which means even if you're getting the loan for 4.5%, you have to be able to afford it at 6%.
Okay.
So there's a little bit of a cushion built in there
Yeah.
for future advances as well. And candidly, if you just took out a 7-1 loan, my belief is that interest rates on mortgages will probably go down in the next 18 to 24 months. So you'll probably be able to refinance into a 30-year fixed rate loan at the same or lower rate than what you currently have today.
Yeah.
So I don't see a huge potential problem with those loans. Obviously, market conditions could change. We don't know what might be in store. I remember a few years ago I was talking about how amazing the U.S. economy was, and how the housing market was on fire, and it would, nothing short of a global catastrophe could knock things off track. And you could almost hear somebody biting into a bat wing at that point in Wuhan.
Yeah.
And so I don't tempt the universe anymore.
No. Yeah.
But I don't see today's adjustable rate loans being a foreclosure crisis or a negative equity crisis a couple of years down the road.
Okay. Yeah. I've been interested in that because there's, a 2-1 buy down. There's all these other different creative strategies that lenders have come out with. And I know that they have to change with the market and make sure that they're still providing value and or thinking creative for the borrowers. But at the same time, you just don't want to see that again and push that to a limit where, 5-6 years down the road, we're all of a sudden back in, what we experienced 12 years ago, 14 years ago.
Again, there are pretty clear lines that the CFPB has established in order to get a loan that fits within its qualified mortgage box.
Okay.
Most lenders pretty rigorously color within those lines. So even where you're seeing some of these new loans where you're temporarily buying down points, I would be willing to bet you that borrower is financially qualified to handle the full loan at current mortgage rates,
Yeah.
and is only qualifying for this buy down because it's a good financial tool for them to use, and the lender is confident that they won't default a year or two down the road. We have the same question, by the way, about home equity lines of credit.
Okay.
So if you're in the lending industry, you probably know that the only part of the business that's growing right now are these home equity lines, HELOCs.
Yeah.
And I had somebody ask me earlier today at a webinar, are you a little concerned people are going to use these as use their home as ATMs again? Or, are we running the risk of home prices going down, these HELOCs being underwater? And again, so first of all, we've seen HELOC activity jump remarkably. So the last 2 quarters, Q3, Q4, we each saw about 44% more HELOCs written than the year prior.
Okay.
Interestingly, Q4 and Q3 were almost identical.
Okay.
So we didn't see much of a growth in Q4, which leads me to wonder if maybe we're peaking for this cycle.
Okay.
But again, the loans are more stringently underwritten. You can only issue a HELOC with a minimum loan-to-value ratio.
Yeah.
So you can't do 125% LTVs like
Yeah.
they did last time
Yeah.
and get people into trouble.
Yeah.
I remember driving home, my wife would ask me how the neighbors were affording 2 boats in their driveway and the big screen TV they just bought, and I said they can't.
Yeah.
This is going to end badly for them.
Yeah.
And sure enough, when the market turned, those were the houses in the neighborhood in foreclosure. We're not seeing that kind of lending this time. And I believe, because of what we talked about earlier with rate lock and people staying in their homes, we're going to see people tap into the equity they have because they know they're not going to list their house for the next year or so.
Yeah.
So they're going to invest in the house. They're going to make it more livable. They're going to upgrade, which hopefully will ultimately pay benefits for them when they do decide to list the property.
Yeah.
But we're going to see HELOCs for home improvement. We're going to see HELOCs for debt consolidation, especially as credit card rates go up with the Fed funds rates going up. That's not a bad way to tap into your equity as long as you don't run up your credit card bills right away, right after that.
Yeah.
We're going to see maybe some educational bills and medical bills paid with home equity lines. So it's a different lending ball game than it was 10, 15 years ago. And while I believe lenders, are really competing for business right now, in some cases they're desperate for business, I haven't seen the kind of recklessness in lending that you might have seen in a prior cycle. Just again, because I think there are much stricter rules in place and much more severe penalties for disregarding those rules.
Yeah. Yeah, no, I agree. I've seen it and heard stories about, a long time ago, wasn't in real estate at that time, but heard a lot of stories, also have seen a lot of changes and or, seen what used to happen to what's happening these days, and it's changed the landscape, like you said. So
I've seen the same thing with private lenders, by the way, and I guess this is probably more your area that you participate in with a lot of your podcast listeners. You're going to get a bridge loan when you're going to do a fix and flip. You're not going to get a 30-year fixed rate mortgage.
Yep.
You don't qualify for it, among other reasons.
Yeah.
You're probably, in a lot of cases, looking at short-term lending, even for single-family rental property, because you might be able to get better financing terms once you have a tenant in place. So the lenders I talked to in this space obviously have raised their rates. They were in the 6 to 9% range for a bridge loan 6 or 7 months ago. They're now in the 9 to 12 range, depending on where you are. But they're also requiring more skin in the game from the investors, so higher down payments. They're looking at investors' track records before they even issue the loan, and they have variable pricing based on your track record as an investor being successful with your fix and flip business.
Yep.
And they're going over, you talked about as repaired value earlier. They're going over those kind of numbers with a fine-tooth comb. So we're not seeing much in the way of recklessness or even too much generosity when it comes to the private lending industry either.
Yeah, no, I've seen that too. The changes, the adjustments to make sure that they're aligned with, what the market's doing and how like you said, doing their due diligence on the person way deeper to make sure that they're not stuck, holding the bag if the market changes even more than what it has.
And I should have mentioned this with HELOCs too, that the other thing that people have to remember about these home equity lines is these are mostly portfolio products. And what that means for people who aren't familiar with the term is the lender who issues it keeps it on their books. So in most mortgages, overwhelming majority of mortgages, these things get bundled up in securities and sold on the secondary market. So Wells Fargo may have issued your loan, but they're not holding it on their books.
Yep.
So if anything goes wrong with that loan, that becomes the problem of whoever bought it or bought the security that holds it.
Yeah.
In a home equity line, there's really not a secondary market for these things.
Yeah.
There's not a securitization platform where you bundle a whole bunch of HELOCs and sell them to somebody. So really the only people issuing them are depository banks, like Bank of America, I think, is the leader in this category. I think they probably issue more HELOCs than the next 4 or 5 lenders combined. But surprisingly, underneath that, it's credit unions and local community banks who know their borrowers, know their members, and have a personal relationship with them. So they're okay keeping those loans on their books because they have a pretty good idea of who is and isn't a safe bet when it comes to making that kind of loan. So same thing you're talking about with the private lenders. They do their due diligence on the person taking out the loan. This isn't the kind of paint by numbers scheme that you have with getting a refi loan from somebody when you click on an ad on Google.
Yeah, no, for sure. I agree. Well, Rick, we'll transition. Just a couple other questions. I've asked you the same questions before, but I'm going to change them up a little bit. So one word to describe 2023 housing market.
Slow.
Okay. All right. And then...
No, challenging. I like challenging better.
Okay.
Let's go
All
challenging.
Right. Challenging. And then do you see, as we progress in 2023, an adjustment down in interest rates? What's the data showing you on that?
Well, there's data and there's my hopeless optimism. Okay. I'm one of the few people who has said out loud that I think mortgage rates may have peaked for this cycle.
Okay.
We were up over 7% as the nominal rate. I don't think we're going to exceed that, assuming that inflation keeps trending down the way it's been trending. Because I think the Federal Reserve will be able to get less aggressive, hiking the Fed funds rate, which should settle down the mortgage markets a little bit. And it's important to note that mortgage rates for a 30-year loan tend to track with yields on the U.S. 10-year Treasury bond. And they're usually within about 150 to 200 basis points, 1.5 to 2 points.
Okay.
So if the yield is 5%, you might see a mortgage at 7%.
Yeah.
Right now, they're 300 basis points apart. So there's actually room, and that's because of risk and volatility.
Yep.
There's actually room today to see mortgage rates come down.
Yeah.
So they could correct. I don't think they're going to correct that quickly, but I believe that we've already peaked.
Okay.
We'll stay in the 6s for a while, but I believe and I'm hopeful that by the end of this year, we're back in the 5s.
Oh, nice. Okay. All right. Yeah. I mean, you've seen it already. The last 6 weeks, they've trended down.
Yeah, they bubbled up again a little bit last week, but
Yep.
but overall, the trend has been down and it's been going in the right direction, I believe.
Yeah, for sure. Well, where can our audience find more about you and ATTOM and everything?
So we publish a lot of this data weekly. We do weekly reports that are free, by the way. The website is ATTOM Data, ATTOM data.com, and there's an insights section on the website where you can find all these reports. You can also follow us on Facebook, Twitter, and LinkedIn. And you can find me on Twitter and LinkedIn as well. It's just Rick Sharga. That makes it easy for me to find myself. But and if you'd like to connect on LinkedIn, feel free to reach out to me. Just mention that you heard us talking on the podcast, so I know you're not some bot trying to sucker me from some Russian nefarious action group. So,
Yeah.
But yeah, they can find me on LinkedIn, Twitter. Find ATTOM on the same places.
Cool, man. Rick, I appreciate you coming on the podcast here in person on the first one.
Nice to do these in person and not have to wear masks, and hope to do more in the future with you.
Yeah, me too. Thanks, Rick.